It's been a very different year in Australia's housing market. Overall, national housing values fell 3.2% over the year to November. Joining me now is economist at the REA Group, Angus Moore. Angus, good to see you. We are nearing the end of 2022, just a couple of days to go now. A very different year in property compared to the last year, or last decade, in fact. Describe to us 2022 in Australia's property market.
Yeah, thank you very much for having me. It's certainly been a different year. I think maybe before we get into 2022, it's worth putting 2021 in some context to see just how big a change it is. We saw prices in 2021 up the third fastest pace of growth in 140 years, basically as long as we have records for house prices in Australia, and the fastest since the 1990s. So it was a banner year by any standards. And this year, as you say, we've seen prices come off. Since peak in March, prices are down 3.8%, according to the PropTrack Home Price Index. And the big change and the reason we've seen that big deceleration in house prices is that the RBA's raised interest rates very briskly. We sat with interest rates at very low levels for much of the past decade, but particularly through the pandemic when interest rates hit effectively zero and mortgage rates fell below 2% for many borrowers. That's changed this year. Interest rates have already risen above 3% and mortgage rates have followed. And we'll continue to see that over the next year, and that will drive prices lower into 2023 as well.
And are we expecting there to be particular areas where we'll continue to see the largest falls? Or, like we've been hearing throughout the year, that Sydney and Melbourne has really copped it more than other areas, and Adelaide's been doing really well. Is that the picture that we are expecting to continue into next year?
Yeah, that's exactly right. The broad point is there's going to be a headwind for everyone. Those higher interest rates have materially reduced borrowing capacity for would-be buyers. They're down something like a quarter or more for most borrowers already. And with further interest rate rises expected, we'll continue to see those maximum borrowing capacities decline. That's going to put a big headwind on prices right across the country. But within pockets, we will continue to see strong demand, and places like Adelaide are continuing to see prices grow this year. We're actually still seeing prices at peak in Adelaide despite that headwind. Now, we'd expect we'll see that headwind start to prevail even in Adelaide next year, and we will see prices fall there. But they'll probably hold up a bit better than, say, Sydney and Melbourne, where we've already seen larger price falls.
And
part of the reason for this...
Sorry to interrupt. Is Sydney and Melbourne is the reason why they're falling the most is because they are the most overvalued, would you say, and so they needed to come back to the median a little bit more? What's the reason Sydney and Melbourne has really copped these declines more than other areas?
Affordability is certainly a part of it. Adelaide's obviously a much more affordable city than Sydney or Melbourne. Brisbane is also more affordable, and we're seeing prices hold up there as well. We did also see a big migration from Sydney and Melbourne during the pandemic to some of the smaller capitals, Brisbane in particular, but Adelaide as well to some extent, as well as other regional areas. That really was one of the big stories of the pandemic. To date, that hasn't yet changed. We're not seeing the same flows that we were, though the data are somewhat dated because it's surprisingly difficult to track where people live. But we haven't seen that reverse yet. And so that demand hasn't come back for Sydney and Melbourne in the same way that it was there pre-pandemic. But broadly, in an environment of higher interest rates and reduced affordability, we'll probably start to see buyers substituting into more affordable areas. So that would be Adelaide instead of Melbourne, for instance. But even within cities, we're seeing that play out as well. So outer suburbs are, at the moment, holding up better than inner city suburbs. More expensive suburbs have seen larger falls than more affordable ones. So we'll see that pattern writ large over the next year as higher interest rates weigh on affordability.
Okay, and despite the rising interest rates, is it still manageable to obtain credit? Are banks still happy to lend at the moment?
We are still seeing credit growth, particularly in some areas, for investors in particular. So the investor share of new lendings up to a third, so 1 in 3 new mortgages, roughly speaking, is going to an investor. It was as low as a quarter or even less during the pandemic, which was actually a very low level. I'd expect we'll continue to see a lot of demand for lending to investors and a lot of demand from investors for housing over the next 12 to 18 months, given the rapid increase in rents that we're seeing, and that will start to rebuild rental yields and make investing in property a bit more attractive than it was over the past 2 years. The other factor there is that rental vacancy rates remain extremely low. So the risk of having an untenanted property as a landlord is pretty low at the moment, which again makes it quite attractive as an investment.
There's not a lot of stock on the market right now in terms of sellers wanting to sell their homes. They seem to be holding off for better times. How much do you think they can hold out for, and will we see increased stock come onto the market next year?
Yeah, it's a great question, and it's been an interesting dynamic over the past 12 months. We saw an extremely busy late spring last year. Early spring was crimped by lockdowns, and so late spring was where all the activity was concentrated. And by some measures, November was as busy a month as we've had in a decade in property markets. That busyness continued through the start of this year in 2022 and even into winter. Winter's typically quiet, and it was quiet this year, but it was still relatively busy for a winter period. But spring really started to see activity slow down. We saw far fewer new listings this year than last year, and even relative to some pre-pandemic years. So things did start to cool off. The good news for buyers is that despite fewer new listings coming to market across spring, we're starting to see homes take longer to sell, which means the total inventory of homes available for sale in Sydney and Melbourne in particular is actually now well above where it was pre-pandemic, and it's back above its decade average. So there is still plenty of choice for buyers, even if there's a little bit less new stock coming to market in recent months.
One last one for you, Angus. If we do see a full another year of price declines, how significant would that be?
Again, it's important to put in context just how quickly prices rose during the pandemic. So from February 2020 to the peak in March this year, prices were up something like 35%. So even if we see price declines in the order of 10 to 15% from peak to trough, which is broadly speaking what we're expecting we'll see, most homeowners that bought prior to the pandemic, and that is most homeowners, only around something like 1 in 20 homes turns over in a year, most homeowners will have seen a huge increase in their equity. Now, that's not true for any, and for all homeowners, and certainly some that bought more recently in the past 12 months or so, will start to feel that higher affordability, that increase in serviceability costs and the decline in equity, and that could put pressure on some people. But that context is important. A lot of people are sitting on big price gains.
Okay, Angus Moore, thanks so much for your time.